Hi, everyone. This is Jason Bierk of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. We've had him on a number of times. He founded Global Resource Investments, and he's now under the Sprott family of companies, working with Eric Sprott and John Embry and the other top resource investors in his field. He's one of the most respected people in the resource industry, and we're glad to have him back on. So Modud and I are joined today by Rick Rule. Thank you for joining us again, Rick Rule.
Always a pleasure, gentlemen.
Rick, I want to start off by talking about the economy. Now, the mainstream media and politicians are doing their very best to try to prop up the economy and try to convince a lot of people that the economy is fine, despite what we're seeing out there. If you look, you should read between the lines and see what's really going on in the economy. They're claiming that the consumer spending has grown in the U.S., despite there's no growth in the economy in general, especially if you look at the household income that continues to drop for the past decade. Why do you think this is happening?
Well, I think the economy is working for old, fat, rich guys like me, just not for everybody else. I think these policies of so-called fiscal stimulus are idiotic. They're debasing the currency, and they're building in inefficiencies and malinvestment in the economy, and I think it's tragic.
Yeah, that's a great point, Rick. And to add to your point there, I mean, the loans that are being given out, like we talked about this before we started recording, there's loans being given to Japan at basically zero, Japanese government bonds. There's still some demand for Japanese government bonds, although that's decreased. The demand for government bonds, at least in Europe, maybe it's the European Central Bank printing the money and handing it to the banks, and the banks are buying it, but those interest rates are below the U.S., and then the U.S. government has abnormally low borrowing costs, and then on top of that, you know, at lower levels of the U.S., you have all these different levels of government there borrowing massive amounts of money, and the U.S. consumer, as you mentioned there, is they're borrowing, they're leveraging up to the hilt still. They're consuming massive amounts. They're not taking this cheap debt that seems to be out there, this artificially cheap debt, and they seem to not be, you know, buying assets with it to generate more cash flow. They seem to be consuming with it, either buying more cars that maybe will be repossessed in the next couple of years, or you know, buying degrees that in a few years in the wrong major that might not be able to pay back their loans with.
Well, I think those are all great points. With Basel III, of course, the banks have an incentive to borrow very short-term funds from depositors, or ironically from central banks, and lend that money in 5 or 10 year duration to insolvent sovereigns, leaving apart the credit risk, the time spread risk that these banks are taking at the urging of the multilateral institutions are the same time spread risks that brought down the savings and loan industry. The idea also that this money that's being borrowed by the government is being invested, that's a wonderful term that I think really it was Clinton that introduced into the political lexicon as a euphemism for spending, is achieving very much that's productive, I think is counterintuitive. I think it goes to subsidize the exact type of wasteful consumption that you are speaking about, the purchase of consumer expendables, like, by the way, a college degree that can't get you a job. And I agree with your analysis in every sense. I also think, separate and apart from the utility that the governments may or may not achieve when they spend your money, that the idea of lending them money at these extraordinarily low interest rates, given the difficulties that I believe they're going to have paying it back, and given the fact that these interest rates do not, in my opinion at least, cover the depreciation of the purchasing power of the currencies that they are borrowing in, brings up Jim Grant's famous phrase with regards to government debt at these interest rates, describing the instruments as, quote, return-free risk, which does not seem very attractive to me.
And there's no such thing as risk-free risk anymore in the investing world. I mean, Treasury bond is not considered risk-free anymore. I mean, there's a lot of risk when you buy a Treasury bond, especially when you consider that you get negative return if you factor in inflation. And the main culprit behind that is the central bank and the Federal Reserve, which continue to print money endlessly to keep the Wall Street Bank propped up, and which is why, as you said, the wealthy elite continues to grow in household income while the middle class and lower class continue to get punished. Do you think the Federal Reserve actually knows what they're doing behind closed doors, or do you think they have no idea what they're doing because they blindly follow central planning economics?
Well, yeah, I think the truth is somewhere in the middle. I think central bankers believe in central banking. My friend Doug Casey has said that they're, mostly people from good families who went to good schools and who otherwise might be bagging groceries at 7-Eleven. I think that's a bit harsh. I think they believe in what they're doing, but I also believe that they're politically motivated. I think that they're very, very, very afraid of the alternative, which would truly be a reckoning. My own belief is that the sooner that we have the reckoning, or at least some form of reckoning, the sooner the moral hazard associated with the central banking activities will depart the economy, and the better off that we'll all be. But I like to assume that these ladies and gentlemen, the big thinkers, as I call them, that pollute global finance, are well-intentioned, if misguided.
Yeah, I think it's very interesting here because they're just coming from the exact opposite perspective. Rick, you've read Austrian School Economics. We're akin to the Austrian School Economic perspective here, and when we talk with Keynesians, we really don't agree with them on anything. I mean, there's very little that we do agree with them on, except that a gold standard would essentially be deflationary. Except Keynesians view that as bad, and Austrian School or free market school would view a gold standard as good, preventing the government from generating a welfare warfare state and stealing the purchasing power of its citizenry and its savers and things like that.
And it's worthy to note that today John Maynard Keynes wouldn't be a Keynesian. Keynes himself suggested that you needed to run a surplus in good times. Either the governments since Keynes' time have never been able to identify a good time, or the alleged Keynesians today recognize the Keynesian thesis as justification to continue to increase the domination of every aspect of one's economic life by the state. The Keynesian politics of today aren't Keynesian.
Well, I read the general theory, and I read Henry Hazlitt's analysis line by line through the general theory, and Keynes seemed to be citing a lot of Marx in there. And, the savers are evil people and they hurt the economy and things like that. But, you can't have a healthy economy without capital, without surplus and creating value and things like that. You can't just, go into debt and borrow and consume. Maybe for a short amount of time, a family can do that on their credit card before they get into trouble. But without their income rising, the family's in a lot of trouble. And I don't think the Keynesians understand the balance sheet aspect of it, that you can't just grow debt without, growing revenue and profits and things like that.
That's exactly correct. The ability to service the debt doesn't seem to enter into their discussion.
Now, Rick, let's just say that you were elected president of the United States for 1 year. What would you do to try to turn around the economy?
Well, to quote my old friend Carl Hess, the first thing I would do is demand an immediate recount. A year simply isn't enough time. I suspect that the first thing I would do is ask the federal government to default on the national debt. It's unserviceable anyway, and I think that people who were foolish enough to buy the debt while simultaneously offering succor to the enemy should be punished. I realize that's an extreme view, but since you asked me, I'll answer it. All of those alphabet soup agencies which pretend to protect the American public, the Food and Drug Administration, the FDA, the Rural Electrification Administration, I would allow all those really decent, hardworking people who staff those agencies, and by the way, I'm not being facetious, I think most of them are good people, I'd allow all those people to go find productive employment. I would be honest to the older people like myself who believe that they are going to be entitled to receive benefit from actuarially bankrupt programs like Medicare, Medicaid, and Social Security to learn the truth. And then I do whatever I could to get the government out of the way. The United States is still the most creative and aggressive society on the face of the earth. You think about a couple of pimply-faced young college students starting Apple or Google or Microsoft, and you marvel at the way this country can both create wealth and create utility for customers if you just leave it alone. The problems that we have are manifold, and you would have to address those. We have almost $18 trillion in on-balance sheet obligations, and so something would have to be done to pay off that debt. And I suspect you could go a long way towards that by auctioning off the property of the U.S. government. And then you need to deal with the $70 trillion in off-balance sheet liabilities. And I suspect that you would do that by simply telling the beneficiaries the truth. An example would be, by the way, off-balance sheet liabilities. People act sort of ignorant as to what those might be. Well, I'm 61 years old. I'm pretty close to being an off-balance sheet liability myself. And people of my age and people of your age over time need to become aware that actuarially this society doesn't have the ability to sustain them in the way that they have promised themselves through the ballot box that they will be sustained. A wonderful example would be Social Security. When it was enacted, as I understand it, the benefits were intended to help people over age 65 sustain themselves, but at a very, very, very poor level. And at the time that was enacted, my understanding is that the median lifespan for an American male was 66 years. So they proposed to sustain the average American for 1 year at basically a poverty existence level. Now the average life expectancy of an American male is 82 or 83 years, and the level at which they expect to be maintained is much, much, much higher. And while it's a very nice, very generous promise, it's clearly unsustainable. And I both suspect and hope that people your age tell people my age that we promised ourselves this benefit and we can deliver it to ourselves, because you have no intention of incurring a liability that we incurred on your behalf.
Yeah, small business and entrepreneurs, Rick, we need to get that growth engine going. We still have Silicon Valley. We still have the shale oil boom, the shale oil revolution, which, without those two things and the Federal Reserve also printing money with the quantitative easing programs, the U.S. probably would have already collapsed probably worse in 2008. The trade deficit would have exploded even further, and, the oil price would have went through the roof. Food prices would have went through the roof and things like that. But, in terms of the regulation and the big government that you mentioned, I think that's important. Ronald Reagan did try to reduce the government bureaucracy, but it was so entrenched at that point that, he also did create the war on drugs, and he was fighting the Cold War with the Soviet Union, but he did try to defund so many other government agencies that it was too late. He couldn't do that. The bureaucracy was entrenched. So I think we're on kind of a runaway train here. It's probably going to get worse, unfortunately, with the bureaucracy before it gets better. But, we need to get back to American entrepreneurship, cowboy capitalism as it's called, where, there's low taxes and low rules and regulation, low barriers of entry for people, so entrepreneurs and small business can allocate resources and figure out where to best put them in the economy to create value and earnings and jobs and things like that.
Agree with everything you say.
Okay, great. So let's shift gears here and talk about commodities, specifically gold and silver markets. Gold and silver has been pretty quiet for this year, 2014. So I just want to ask you straight up: are you enjoying this, or is this becoming a little frustrating for you?
Oh, not frustrating at all. This is precisely what an emerging bull market looks like. What we have seen since the lows a year ago in July is a pattern that is very, very, very familiar to me. It's a saucer-shaped recovery. The market is making higher highs and higher lows, but every advance is consolidated with a decline. This is precisely what you expect when a bear market is unwinding and turning into a bull market, where metal or whatever commodity is involved in the market that you're discussing moves from weak hands to strong. This is a market that's doing exactly what it is supposed to be doing. And importantly, it's an international market. It's a market where leadership varies from, China to Russia to U.S. retail. It's a very, very healthy market from my point of view. Now, the fact that it isn't recovering fast enough to suit some people who might be leveraged participants is not particularly of my concern.
Yeah, I mean, sentiment is still really negative from Western investors. Most people on Wall Street still bash gold or silver in public. Maybe they're buying it in private. Maybe they're buying a good amount of physical gold and silver in private, and, they just want it as cheap as possible, and that's what they're saying in public to keep the sentiment low. But, the most of the people in the West are not long-term value investors. They're not contrarians like you, Rick. They're not willing to wait 3 to 5 years to make a big return on their investment. They're trend traders and trying to chase charts.
I think most investors that are ignoring gold are really simply people who are not very good at math. If you look at gold versus what I call the anti-gold, the U.S. 10-year Treasury, to me, the options are extremely stark. The 10-year Treasury promises you absolutely and completely, and by the way, I believe them because they have the printing press, that they will pay you 2.7% on your money over 10 years. Now, it's my belief that the currency is depreciating at about 5% compounded. I'm reminded, as I have talked about in your show before, that I pass a Motel 6 every day on my way to work. And the sign at Motel 6 varies in terms of a price of a room between $60 and $110. It was named Motel 6 because when I was your age, a room there cost $6. We're left with two choices. Either the utility of a room at Motel 6 has increased tenfold over the last 30 years, which is difficult because the room is the same size and I suspect the sheets are the same, or the purchasing power of the room, the denominator, has decreased by 90% over 30 years. So if you accept my premise, what the U.S. Treasury is promising you is that they absolutely, positively will pay you 2.7% in a currency depreciating by 5% a year, or put differently, that they will reduce your purchasing power by 2.3% compounded over 10 years. Or, in other words, if you give them $100,000, they'll give you back $60,000 in purchasing power. And this is supposed to be a better proposition than gold. As I say, my suspicion is that people who take the front side of that trade, the Treasury trade, are people who can't do simple math.
Now, Rick, I want to ask you about the producers of gold, and you did talk about currency depreciation and inflation because there's more currency units chasing the same or fewer goods or services, which leads to higher prices as an effect of inflation. I want to ask about the mining industry, though. I think it's indisputable, basically, that the mining industry has had enormous cost inflation the last decade or so of that. We've had the last 18 months where miners have tried to cut a lot of the fat, the debt. They've tried to trim the debt. They've slashed exploration budgets. Their SG&A, selling general and administrative expenses, for listeners who are not familiar with that term, they were enormous and they've been slashed. Is there any more fat left to cut in the mining industry, or are these guys pretty lean and mean now, in your opinion?
Lots of fat left to cut. Lots and lots of fat left to cut. I think both of you and myself would agree that the private sector can do anything better than the public sector. And unfortunately, that includes selling phony baloney inflated paper, which the mining industry has done relentlessly for 40 years. The industry's worst wounds are self-inflicted, and investors need to understand that. that general industrial malaise hides the fact that the top 5 or 10% of the issuers can generate enough performance that they add legitimacy and occasionally even luster to an industry that's woefully, shamefully inefficient. Sprott has recently come out with an exchange-traded fund that's built precisely on that premise. Rather than doing a market cap-weighted gold miners index, we've done an index that focuses on things like cash generation and
it's really good.
equity to debt, a qualitative ETF, precisely as a self-defense mechanism, because the market cap weighted indexes would seem to encourage the sort of profligate idiocy that has polluted the industry for so long.
Yeah, that Sprott gold mining ETF looks great compared to GDX and things like that and the XAU, because you have the royalty and streaming companies in there which have generated more free cash flow than anyone else over the long term, and that's the majority of the weighting, right?
That's correct. There's a couple of fairly efficient senior producers and a couple of efficient mid-sized producers in there. But we aren't attempting to reward people for sheer size. We have a sort of a unique requirement that they earn money.
Now, in terms of the mining production costs, one more quick question here. In terms of, do you think then the miners will have to be the producing miners will have to start putting producing mines that were marginal and that were brought on after 2008 crash with the premise of higher metal prices? Do you think those are going to start getting put on care and maintenance soon then, or the miners have they hedged too much of their production, or they have too much debt to be able to do that?
No, I think that the mining industry will be forced to be more careful with capital, which is a different way of saying they are going to have to shut down some producing operations. And they're going to have to do them for a couple of reasons. It's true that many marginal mines got brought in production because of a very low cost of capital. And the idea that the Wall Street participants had that the gold price was going higher. So it allowed very marginal deposits to be put in production. The second thing that happened is if you look back 15 years or so, the mining industry's produced grade was substantially higher than their average head grade or resource grade, which would suggest that the industry engaged in widespread high grading, which of course sterilizes a bunch of the surrounding rock. Those chickens will come home to roost. I would also encourage your readers and listeners, when they look at the industry average stated cost of production, that they focus on total cost, including G&A, and especially including the charge-offs, the capital write-offs that the mining industry has taken over the last 20 years. Because the depreciation schedules that are published associated with the major mining companies generally don't take into account the capital write-downs. If a deposit has been written down in terms of its acquisition or discovery and development cost from, say, $3 billion to a $1 billion carrying charge, the depreciation on the income statement and the balance sheet is from the $1 billion number rather than the $3 billion that the shareholders spent for it. So it's very important that when you look at the industry cost of production, that you add back the money that they wasted and wrote off.
And that's a great point. A lot of the companies out there, we notice, leave off a lot of numbers when they calculate their total cost per ounce. And I was reading an article last week, and it's in relation to production costs. And this article talks about energy costs and how the gold and silver miners are having trouble combating energy costs. And one of the reasons why is the haul truck. They consume a lot of diesel. And I also found out that the tires on these haul trucks actually cost more than the truck itself over the life of the vehicle, which is I found amazing.
No, they actually amortize those tires in cost per hour. The point you make is extremely good. One of these great big haul trucks has an absolute fortune in rubber on it. And so the operating costs that you describe are, as you suggest, monumental.
Yeah, I mean, I've looked at this, Rick, and I don't see any way that the producing miners can cut that much more fat out of their SG&A. They've cut their SG&A, a lot of them, enormously. They've cut their exploration budgets to the bone. I don't see any way that they can cut any more expenses without starting to shut down mines. And then that's going to affect the price of gold and silver.
I disagree with that. I think there's a lot of fat in G&A.
Okay.
I think the industry needs to see a lot more horizontal mergers. That is, juniors going away, and we need to see vertical mergers. We need, in particular, to see a merger between Barrick and Newmont, which would, we believe, save shareholders about $1 billion a year. Think about $1 billion in free cash from an ore body that is G&A savings that never depletes. It's a wonderful business decision. The fact that it hasn't happened, I think, is an indictment of institutional investors such as ourselves for not forcing it to happen. There is way, way, way too much G&A in the mining space. And so, yes, I think that fat must be cut in the context of abandoning or at least putting on care and maintenance mines that don't generate operational cash. But I also think that the industry needs to be much more aggressive on general and administrative expenses. And the most important way to do that is increasing levels of mergers.
Now, Rick, one more question regarding the gold and silver sector, and this goes for a lot of mainstream investors out there that want to invest in the mining stock and have low tolerance for risk. Would it be better for them to invest in a royalty streaming company or a mining ETF like GDXJ or SILJ? For example?
Well, I think it depends on the nature of the investor. If you believe that the gold and silver prices are going to go up, you start your portfolio by investing in gold and silver, either physical gold or silver or one of the exchange-traded funds or trusts, such as the Sprott Physicals Trusts. The next step, that is the move into the gold equities, is really a function of how much risk the investor would like to take in search of alpha. And how much work the investor is willing to do, because the more risk one takes, the more necessity there is to spend time and trouble to increase one's treasure. The easiest way to go about it, to get portfolio weighting, I suspect in all modesty, is our own ETF, because it was put together to generate, if you will, active beta. It was intelligently constructed rather than constructed around a passive index. If one is willing to work a little harder, yes, certainly, the most conservative way to participate in the gold equities, and historically the smartest way, would be to buy the royalty and streaming companies. Not all of them, but the ones, and I don't want to give too much away, but the ones that have the lowest cost of capital and the ones that have the best built-in production growth from acquisitions that they have made on projects that either aren't producing or are still ramping up.
Very good, Rick. And in terms of the juniors in the gold or silver, I have one last question on gold and silver juniors before I move on to your view of other commodities. Do you think that the junior projects you're looking at now, they focus more on cost control and cost cutting and trying to find those low-cost projects more now than necessarily, looking for elephant deposits that are maybe low-grade and stuff like that? Or is it more about the way that the deposit can be mined than necessarily grade?
Most of the juniors concentrate on looking for salaries for their management teams, and the deposits are really an excuse to justify, fishing trips off Brazil or fly fishing in northern Canada. If you segregate out the lame and the halt and the blind from the rest, you've probably taken 60% of the market away. I would say that the very best junior issuers have always been focused on searching for economic deposits, although that's been tempered a bit 10 or 15 years ago when optionality came into play, and they could lower their cost of capital by looking for large low-grade deposits. Traditionally, for most markets, I myself have focused on decent grade deposits, although in times of deep bear markets, I'm thinking 1998 to 2002, when the optionality stocks were in effect sub-zero, as an example, where Ross Beatty could buy a copper deposit for $3 million that it had $80 million spent on it. I favor a speculation in the very large projects with high upfront capital costs when they're free in the market. And the revulsion associated with those projects is becoming extreme enough that although I was a big critic of that style of investing in the 2007 to 2010 timeframe, I'm beginning to be interested in speculating in optionality now simply because it's such an uncrowded trade. And also because I believe that the price of gold and silver are going to go up.
Rick, I want to shift gears here and talk about other commodities. Start off with base metal. What is your opinion of base metal? Should investors allocate their portfolio in this sector, in this type of economic environment? I personally think the only base metal I would invest in right now is zinc, and that's because of the supply crunch that's coming now. There's only a few handful of mines out there that supply most of the zinc, and a lot of them are close to depletion. So what do you think?
Well, Eric Sprott agrees with you. Eric's economic outlook is even more bleak than mine, and he really doesn't have any interest in base metals. I'm becoming more interested in them. And the reason I am is despite a very, very weak real economy, I'm not talking about a liquidity-driven economy that focuses on resales of existing homes and stuff, but in the face of very weak investment demand and demand for consumer durables in markets like Japan, the United States, and Western Europe, the base metals prices have held up reasonably well. And the reason for that is moderate or declining supply of base metals and the dearth of capital available in debt markets to put big base metals projects into production. If we get any sort of economic recovery in the West, and I'm not saying we will, but if we get any sort of economic recovery in the West, there's an extraordinary pent-up demand for automobiles and for consumer durables. The median fleet age of automobiles in Western Europe, in North America, and Japan is at record levels, and a replacement cycle needs to begin in automobiles and consumer durables, assuming that we get enough of a recovery that workers' real incomes, they don't even need to increase, they just need to keep from declining anymore. And so I have much more of a sense of humor towards base metals than I had a year and a half ago, simply because of the fact that the median age of consumer durables and automobiles is so old, A, and B, the supply constraints that we're beginning to see across the whole range of base metals have kept the price of base metals up in the face of very, very weak industrial demand.
That's interesting view there of the base metals market. I mean, for copper with me, I think China's been stockpiling a lot of their foreign exchange reserves in copper, more so necessarily than gold or silver, because it's just easier to put money into oil or copper than it is to necessarily buy up all the gold or silver that's available, and China can do it without getting noticed as much. So, I mean, for me, with the demand, the amount of demand that's coming for base metals, a lot of it is tied to China. China's the majority of the market for steel, iron ore, and copper, I believe. I think it's over 30% for all three. And, it just depends on your view of China. I mean, I guess China is still growing per se, like with central planning, but they're misallocating lots of capital. So I'm not sure, like, if I agree with you or not, but I see the point there. But what would make me interested in buying base metals again, and I bought Lundin Mining actually after the 2008 crash. I bought it at 30 cents. It was a good deal back then. But would be if, we had this crash in copper or base metal prices where, copper plunged below production costs or things like that. We haven't quite seen that yet. So I've been kind of waiting for that, whereas a speculative trade, that would interest me if that happened, where the base metal prices just plunged.
Certainly, I had that point of view a year and a half ago, and I don't actually discourage any part of the line of thinking that you have talked about. I am not a short-term China bull. I'm a long-term China bull. But what really interests me in the context of base metals is, as I see, constrained production and a constrained ability to bring new production online. And when I look at the pent-up demand in markets like the United States, the world's mouth, yes, a declining power, but still 24% of global GDP, it doesn't take very much demand growth to move those markets. The second thing that makes me interested in base metals is simply how little professional sentiment there is in favor of them. And I think in that regard they share an important attribute with the junior mining stocks, which is that bull markets occur as a consequence of a market as a whole exceeding expectations. And the expectations in the base metals markets and the expectation in the junior equities markets are so low that it would be almost impossible not to exceed them. The challenge is to get under the bar, not over it. And in my experience, the type of surprises we see in market conditions like that are surprises to the upside, not to the downside.
Okay, fair enough.
Doesn't mean it has to happen, by the way.
Yeah. I mean, I think a lot of the copper purchases, like I said, in my view, from what I've seen in the markets and stuff that's come out on Zero Hedge and talking with other people, I think a lot of this China sovereign wealth fund money has gone into the copper market or the oil market and is being, parked there more so than in gold or silver, just because gold or silver is a much smaller market compared to copper or oil and things like that.
Yeah, I don't have the expertise to comment on that.
Now, in terms of the rest of the commodities, I want to get your opinion on the shale boom because you don't get asked on it that much. Do you think the shale boom can continue for a long time in the U.S. for real? And do you think it's still a very good long-term investable theme yet?
I think in the U.S., I think production growth will continue. The U.S. public companies have had a good time for so long that they're starting to be reckless with their capital structures. Specifically, there's beginning to be too much debt on the junior and intermediate producers' balance sheets, and that's problematic. I think with regards to the size of the resource and the strength of commodities markets, and in particular as a consequence of the extraordinary infrastructure that we enjoy in the United States, gathering infrastructure, process infrastructure, and storage infrastructure, that the shale boom has a very long way to run. But it wouldn't surprise me to see disappointments given that that market is priced for perfection. Just as we talked about the fact that it would be difficult for the junior miners not to exceed expectations, it will be difficult, I think, for the junior and intermediate U.S. shale equities to meet expectations simply because the expectations are so high.
Yeah, I completely agree, Rick. And what worries me also is that these investments are being talked about, on CNBC, on Bloomberg, by mainstream people who only look at the chart, who don't know anything about fundamentals. But when you dig down deep into the balance sheets, as you mentioned, Bloomberg just did a study on this. The debt is growing, I think, 5 times faster than revenues and earnings, and a lot of these shale oil producers are not really generating that much free cash flow. And when I asked, like a newsletter writer who covers these shale oil companies, all the time and speaks with company CEOs, they say, they're taking this cheap debt and tying up land packages and things like that. They're kind of giving me excuses for why they're not generating free cash flow.
I think that's accurate. I think that's very accurate. As I say, as an economic play, I think it has a long way to go. As a market play, I suspect it's getting very long of tooth for the reasons that you suggested. Many of these companies have for 5 years spent a multiple of what they've generated by way of free cash, and too much of that has been by way of debt. Their ability to continue to do that, particularly if we had a hiccup in oil and gas prices. I'm not saying we're going to, but if we had a hiccup in oil and gas prices and the assumptions behind the revolving credit facilities, the so-called evergreen facilities, changed based on a price assumption change, a decline in the assumed oil price on a production credit facility from $100 to $80, if you're a $60 cash cost producer, means that although the oil price declined by 15 or 20%, your borrowing base declined by 50%. And never mind, you won't be able to borrow to fund next year's drilling campaign. You're going to have to sell some of your existing reserves to pay down your borrowing base to your new allowable. People from outside the industry don't understand the incredible compression that can happen in a liquidity squeeze in an industry that's as capital intensive with as much debt involved as the production business in the United States.
And that's a great point. Now, Rick, before we wrap up this interview, one last commodity we wanted to ask you about is uranium. Like gold and silver, uranium market has been pretty quiet and calm this year. I just want to get your outlook on uranium, and you think we'll see a rebound in the short term or in the long term?
Not in the short term. There's lots and lots of enriched uranium on the market, and we haven't seen any uptake in Japanese demand. Looking longer term, it may be my favorite commodity other than water. And when I say longer term, I think you need to look 2 or 3 years out, which I'm very want to do despite my advanced age. Chemico believes that on a fully loaded basis, the total industry cost, including the return on capital, is about $70 a pound. So the industry makes the stuff for $70 a pound and it sells it for $30 a pound. It loses $40 a pound and tries to make it up on volume. Now, if you consider that and you juxtapose it against the fact that even in the United States, which is rich and fairly anti-nuke, nuclear power generates 16 or 17% of baseload power. It doesn't take a rocket scientist to understand that the industry either has to earn its cost of capital in the next 5 years or the lights go out. Those are the two choices. The choice is that stark. Yes, I understand that renewables are increasing their market share, as an example, and I think that's a good thing. But let's look at solar as an example. What happens at night? People want the lights to go on at night, and solar is challenged at night. What happens with regards to wind when the wind doesn't blow, which happens? The truth is that although they're a hated part of the global energy matrix, uranium and coal, between them, supply almost 60% of U.S. energy.
Yeah,
I'm delighted when I go into the parking lot of my office building. There's 2 elected politicians on the first floor of this building, and their staff is predisposed to drive electric cars. And I delight in talking to these young people and thanking them for using their electric car, which supports my industry, which supports my investment in coal and nuclear, much to their chagrin.
Yeah, and the one thing about another thing about solar and wind, Rick, is that when they're intermittent, like you mentioned, but also that they're backups, and these are built, next to the solar plant or the wind plant, are often, they're either a nuclear plant or a coal plant or a natural gas plant. So, I mean, there's always a backup plant that's built next to it just in case. Most people don't even want to talk about that. I'm sure it's probably the politicians and the environmentalists and other stuff who don't want to talk about that these things, can't carry the full weight of things quite yet. Although, maybe in the future, I'm hopeful with more innovation from more entrepreneurs here in the U.S., maybe that will be the case. But in wrapping things up here, Rick, I just want to thank you again for your time here on this podcast and really giving our listeners a lot of interesting insights to think about, especially in the resource industry. And Mo and I look very forward to meeting you a month from now, and also Eric Sprott in Toronto.
We look forward to hosting you. It's the first editors conference that Sprott has ever had, and we look forward to telling you about what we're doing and hearing from you about how we might be able to serve your listeners and readers better.
All right, Rick. Well, thank you for your time. We appreciate it.
Always a pleasure, gentlemen. Thank you.
If you're tired of losing money with your financial advisor, want to ask better questions to your money manager, or would like to learn to invest on your own, Wall Street for Main Street can help you. Our goal is teaching people how to fish for themselves instead of trusting their financial advisor for everything. Wall Street for Main Street offers high-quality investor education, market research, and consulting, for beginners, high net worth clients, and anyone else in between that wants to learn to adapt to the current macroeconomic situation, profit off of it, or hedge themselves. Please contact us at wallstreetformainstreet.com. That's WALLSTFORMAINST.com for more information. Also, if you love our podcast and website and would like to donate money so you can continue to get exclusive podcasts from top experts, CEOs, economists, authors, and all of our great guests, please go to our website to donate money, go to our Indiegogo page, or go to our iTunes page and give us a great review. We accept donations in fiat currency, Bitcoin, and also precious metals.